if you look at the numbers and you look at the facts, inflation is priced to go back to the 2% threshold. Whether that happens or not, who knows? But I think it's an opportunity for investors to say, look, it's a good time to be like, what if the Fed doesn't have this? What if inflation is global? What if Japan's change of monetary policy is going to be, spilling over to us, just like other economies in Asia have spilled over to the US? Like, I don't really think it's much different. And I think, I like to say this is not, we don't live in Barbie world, we live in a real world, and people should, should be thinking about having some allocation to inflation, whether that's in, metals or real assets, or the rates and inflation markets, which is what we focus on at Quadratic.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a super important discussion lined up today, and I am really excited about it. Today, we're fortunate to have with us Nancy Davis. Nancy founded Quadratic Capital in 2013. She's the portfolio manager for it, and she's formed two funds, the Quadratic Interest Rate Volatility and Inflation Hedge, which is also IVOL, and the Quadratic Deflation ETF, which is BNDD. Nancy, thank you so much for joining us today. Nancy, how do you view the current state of the markets and the economy?
Well, I think there's a lot of complacency out there that things are okay. It's vol has fallen about 30% in 2024. I think there's not a lot of concern, and I kind of want to grab people and shake them, because I think there are a lot of opportunities out there in the market, and it just seems like, so many people are focused on just a very narrow subset.
I would agree. In your view and analysis, do you view that narrow subset being in the AI stocks, the tech stocks? Do you see that as being a trade that's a bubble similar to 99, 2000? Or do you view it more like 1995, where it was the beginning of the tech stock frenzy that went on for several years? And how do you see that whole thing playing out?
Well, I'd like to say, that's my area of expertise. So I think there are two sides to both of those arguments. I've heard them both, but I don't personally have a strong view because I focus on, other markets, and I'm not a stock analyst.
Okay. Nancy, with the fiscal dominance playbook that's being run by the current administration, do you expect inflation to be a long-term regime to play out similar to the 70s and the 40s, or do you see inflation getting whipped by the Fed and everything returning to, pre-pandemic?
Well, the market is pricing that everything's going to get whipped by the Fed, and that there's no concern in markets right now. You can look at inflation expectations kind of across the board. And, I'm just pulling up my Bloomberg right now, and you can see like the 2-year break even is 206, the 5 years 220, the 10 years 223. So the market is saying, the Fed's got this. Don't worry, inflation will be back at 2%. But I think that presents an opportunity for people, because what if they don't, right? What if, because of so many other, whether it's a fiscal situation or even Japan's change of, leadership and changes in their, yield curve control and doing away with it, and now kind of combating inflation on their own. Like, there are a lot of reasons why, it's a good time. I think it was Warren Buffett who said, you make money when you buy something. It's good entry, I think, in my opinion, to own the rates markets to access inflation. I think a lot of people look at the 70s and 80s, and, there was no inflation protected bond market. That didn't even start until the U.S. Treasury first issued inflation protected bonds in the late 90s. So it's a new market. The interest rate derivatives market's even newer. And just, I think a lot of people are not focused on it. And so I think it does present a good opportunity, but it's a good value. It's been going down, there are a lot of problems with inflation protected bonds. And that's kind of why we designed eyeball to seek to solve some of those problems.
So we're definitely going to get into the eyeball and learn more about that and understand how it's addressing some of those problems. But there's a few things that I wanted to talk about first. One of those is the debt to GDP ratio. It's historically high, and several folks believe it's in dangerous territory. There's only a few options to get this ratio lowered into the safe zone, and inflating the debt away is really the big one. Some experts have said that we would need 10 to 15% inflation for 4 to 5 years, 3 to 5% inflation for more than a decade to get the debt to GDP ratio lowered down to about 70. In your estimation, is this the game plan that's taking place right now? And which way do you expect this to go?
I don't think there is a game plan right now. I feel like there is a very there's a lot of uncertainty going on right now with Fed policy. Like even the changes we had going into this year, like when we started 2024, the rate market was expecting the Fed to cut, over 6 times, and that's kind of been annihilated so far this year. So I don't think really anyone has a crystal ball. And I just think, generally most people, to me, inflation is not a trade, right? It's an asset class, in my opinion. Very simply, I like to think about, everybody, no matter what career you're in or what industry, everybody works, right? You make some kind of income and then you save it, right? And the goal is to eventually retire and not work anymore and live off your savings and your investment income. And I think, especially as you get closer to that retirement age, if you think about like your personal balance sheet, you're not going to have any kind of wage inflation, right? Because you won't be in the labor market anymore, hopefully.
Right.
You'll be, whatever people do for their retirement, but you still have a cost of living. So I like to kind of grab people and say, like, look, inflation is not a trade. It's not, do you expect, like, nobody has a crystal ball and nobody knows. But if you look at the numbers and you look at the facts, inflation is priced to go back to the 2% threshold. Whether that happens or not, who knows? But I think it's an opportunity for investors to say, look, it's a good time to be like, what if the Fed doesn't have this? What if inflation is global? What if Japan's change of monetary policy is going to be, spilling over to us, just like other economies in Asia have spilled over to the US. Like, I don't really think it's much different. And I think, I like to say this is not, we don't live in Barbie world, we live in a real world, and people should be thinking about having some allocation to inflation, whether that's in, metals or real assets, or the rates and inflation markets, which is what we focus on at Quadratic.
So long-term treasury bonds have come under heavy pressure. They've sustained losses the last couple of years. Several former large purchasing countries such as China, Russia, Japan, and Saudi Arabia, they've either slowed their buying of treasuries dramatically or they've become net sellers. This at a time when bond issuance is at an all-time high because of the massive deficits, and the government is also needing to roll over maturing debt. So, Nancy, are you anticipating problems in the bond market at some point? And do you expect much of that debt over the coming years to get monetized by the Fed?
So the bond markets are incredibly complacent. Interest rate vol in particular, both of our ETFs, both IVOL and BNDD, are long interest rate vol. And interest rate vol has fallen huge in 2024, which doesn't match, all the fundamentals that you just went through, Gary. You would think, listening to all that interest rate volatility would be higher, not lower. And it popped around Silicon Valley Bank, and none of those problems are fixed, right? It's like everything, all the non-mark-to-market of government debt sitting on, balance sheets of banks and other institutional investors, including the Fed. It's all still there, right? Nothing's different. Yeah. It's just cheaper, and I think it's a good buying opportunity, in my opinion. But both of our funds are long interest rate vol.
Very interesting. So you were talking about the interest rate cuts and that it was about 6 to 7. It got slashed down to 1 to 2 rate cuts that are still priced in for the remainder of this year. That despite persistent inflation that we're still seeing and the fact that current rates really haven't been all that restrictive to date. Canada and a few other nations have recently cut rates while also experiencing inflation in their countries. Are you expecting rate cuts in this environment from the Fed? Do you see them, if they do, as being politically motivated with the election only a few months away? And or do you see them as being more reflective of underlying economic metrics that are requiring them to happen?
So that's a loaded question for sure, and it's hard to know. Look, it's really impossible sometimes to know these things, and I think that's the thing that I really like about the iVol ETF in particular, because it doesn't really matter. It's more of a spread exposure. So whether the fund can potentially benefit from either lower front end yields, so that would be the Fed cutting rates, or higher back end yields, which could be the rest of the world demanding a higher coupon to finance our debt, especially with the Treasury having to issue so many more bonds. And so I think the nice thing is the tips that we own inside of iVol, they're sensitive to real yields, right? So we went lower real yields because we have about 80% of the fund in that type of Treasury bond. But the options don't really care at all about whether, rates are lower on the front end or higher on the back end. We just want the spread to widen. And it happens to be at, right now, the 2-10 SOFR spot curve is negative 70, right? Like negative 70. So it's that going less negative or positive is positive for the strategy, and it doesn't really matter how it gets there, whether it's cuts or higher long dated yields.
I see. So, Nancy, the inverted yield curve has been persistent for longer than any other time in modern history. Inverted yield curves usually are a predictor of a recession when they uninvert. This time, it really isn't showing signs of uninverting. Do you anticipate it to uninvert at some point in the near future? And when it does, will its relatively unblemished predictive capabilities be restored? Or is this no longer a useful metric?
It's people like to say, oh, this time is different, because definitely most of the times going back, you can look at the yield curve going back to the 50s. We have a chart of it in the iVol ETF investor deck, and most of the time the yield curve will start to steepen when we're coming into ahead of a recession. And so it's hard to know whether it's chicken or egg. Is it a cause? Is it knowing? It's hard to know the reasons, but I think one thing we can all agree on is the yield curve is very inverted. It's been inverted for longer than we've ever seen in our lifetimes, and that's why I think iVol is such a it's a good value play. Look, it's not for the faint of heart. You can absolutely lose money. It's down huge this year, so it would be for those value investors who are look, I think this doesn't make any sense. I think interest rate vol is going to higher. I think real yields are going lower and want some inflation protected bonds, but also expect the yield curve to normalize, meaning less inverted or steeper, sometimes are the jargon words. iVol could be a great way to access that market for people, but it's hard to know when it's going to normalize because it's never been this inverted for this long ever. So I like to say, how many things today can you buy in financial markets that are trading at, valuation levels from below the 80s, right? Not a lot of stuff is cheap. And this is one of those few things in the world where it is very, very low valuations.
Yeah, silver's probably another one. I've heard you say that as the yield curve uninverts, it leads to higher volatility. You've called this volvexity. Right? It's your made up word as far as I know. Would you explain in layman's terms why volatility increases as the yield curve uninverts? if you're expecting that to happen this time around, and how your iVol fund smooths out that volatility.
So iVol owns options, and whenever you own options, you're actually long volatility. And so I think that's one of the things, like the fund has the word volatility in the name, and we're pretty proud that we're accessing fully funded options. There are not a lot of people who buy options out there in the world, and most people are selling them either for overwriting, underwriting, kind of selling away equity upside, or other things, or hedges, which again, hedges, they just want to expire worthless for the most part. So our fund is one of the few out there that's actually long only options. So we benefit from rising volatility. And that I think is actually a great thing, because most people in their bond portfolio are only short fixed income vol, and that's because so much of the indices are tied to mortgages, and if you close your eyes and you're like, all right, if I own the Bloomberg Ag Index, which is, it used to be the Barclays Ag, and then it was the Lehman Ag. It's a really old index. Most financial advisors will use the Ag to have, core fixed income. But if you look at what's inside the Ag, it has no inflation protected bonds, zero, none, no tips at all inside the Ag. And then 25% of it is actually short volatility because it's exposed to mortgages. And if you think about, close your eyes for a second, what is a mortgage? In the United States, homeowners are long the option. Owners of financial mortgages are short options to homeowners. And whenever you're short options, you're short vol. So all these people are sitting there with these short vol positions in their bond portfolios. And I want to stand on my soapbox and be like, what are you doing? Why are you only short volatility in your bond portfolio? And so there's a lot of focus on listed products like the VIX, which is equity vol, that short dated equity vol. But I think the big, kind of elephant in the room is that most people have their bond portfolio and it's short fixed income vol, because you're modeling how quickly homeowners will prepay based on interest rates, which is really hard to predict.
So is that partially tied to the disinflationary effects over the last 40 years?
Meaning mortgages?
Well, what you just described with the volatility positioning in their portfolios.
Look, I think it's just a question of how these indices are constructed. Prior to the savings and loan crisis, the entire mortgage market was OTC, right? There was no way to access that. It was only when they got QSIP'd after the S&L crisis, and then mortgages were added to these indices. And it says, core fixed income, but how can you be core fixed income if you have no inflation, especially in this environment, and only short vol? So I think that's why a lot of people will take iVol and they'll use it as a complement to the Ag to say, look, we have the Ag, or we have managers benchmarked to the Ag, but we're going to sprinkle a little iVol on top to add inflation expectations outside of the consumer price index, and have another way to access and neutralize that short vol embedded in mortgages.
Okay. Nancy, are you anticipating an increase in volatility the closer that we get to the election and even after that's decided?
I mean, I'm pretty surprised that vol has fallen so much, given all of the issues that you articulated earlier, Gary. It's not just the election. There's so much going on that it's really surprising. But I think it's really, people are selling options inside of strategies that are called QIS. I don't know if you've ever heard that. It's quantitative investment strategies. It's a very popular bank issued product that's being sold right now. And they sell vol as like a carry trade, right? And selling options, you can only make the premium that you receive, and then you just hope they expire worthless. The issue is that you can lose a lot more than you can make, right? It's like asymmetric bad risk, so to speak. Whereas we own options, so we can always lose money, right? It's not that there's no free lunch in this world, but we always know how much we can lose because the options are fully paid for. So it's a long only product that owns treasuries, and then fully funded interest rate options.
Okay.
Did I explain that okay and answer your
Yeah.
question?
Yeah. So there's been a lot of discussion about King Dollar and how strong it's been over the last few years. What do you
Mm-hmm.
see moving forward over the next 12 months for the dollar? And maybe more importantly, how its purchasing power versus hard or real assets is going to move?
Yeah, I mean we're very fortunate that the dollar has been so strong, and very fortunate also that many, like oil for the most part is traded in dollars. So we're very, very, very fortunate for that. But there's no guarantee that that's going to be the case 20 years from now, right?
Right.
There's no, so I think, a weak currency often happens when inflation expectations kind of get out of control. We do not have that problem right now. We actually have the opposite. We have this very disinflationary expectation in the
Mm-hmm.
future that the Fed's got this. Don't
Right.
worry. Everything is fine, but that's a great time to be potentially adding a strategy like Ival to say, look, what if inflation isn't a thing of the past? What if, we do think at some point, it's normal to have an upward sloping yield curve, right? It's not some tail event, right? It's
No.
just more like the way I think about it is, people right now are willing to say, here, Janet Yellen, like, let me give you money, take my money for longer and pay me less, right? That's what the inverted yield curve means, that the price of longer dated debt in dollars is a lower yielding product than overnight rates, and
Mm-hmm.
that's not normal. So I think it's one of those things that we do see the strategy normalizing and having it go back to a upward sloping curve at some point. Like even Japan has an upward sloping curve. Their curve is positive 70 and we're negative 70. So it's kind of, I think it's really been, the US has been this like shining beacon in the rest of the world. And who knows if that's going to stay the case, and whether the rest of, especially with Japan owning so much of our treasury bonds, like, are they going to
Mm-hmm.
keep financing our debt and, getting paid less than overnight rates? Like, it's sort of like you want to grab people and be like, this doesn't make any sense. Why are people doing this?
So if the sentiment is collectively on that one side of the boat where they predominantly believe that the Fed's got this, then the risk is to the upside in volatility, isn't it?
Yeah, I would think so.
Yeah. So, Nancy, capex spending in commodities, it's been woefully short for more than a decade. With de-dollarization, deglobalization, AI data infrastructure build out, the green and electrification movements, and the rising up of the consumer class of more than 120 million citizens in the Asian circle, do you anticipate a historic rotation of investment dollars out of expensive financialized assets and into hard assets?
I mean, I think there's a case to have diversification across the board. Like, I think, I think people generally should be diversified. I think they should be diversified with hard assets, real assets, financial assets. I think, IVOL gives access to the interest rate markets. It's a whole nother asset
Mm-hmm.
class that a lot of people don't necessarily have inside just a, 60/40 portfolio. So
Yeah.
I think it makes a lot of sense. Like, the whole point of diversification, right, is you don't want your whole portfolio to go down all at the same time, right? If we
Right.
just take a, you know, 6,000, foot view, like, what's the point of diversification? And right now, people, really in 23 and 24, everything has been going up, right? So if everything is going up in your portfolio altogether, you probably are not diversified. And it's a good time to add, other things. And I think, Gary, you have a good story and we have a good story. It's just another tool in your toolkit to add that diversification.
I think your point is so well taken, and I hope everybody who's listening is paying attention to it. Um, I'm sure most people have experienced having, dramatic drawdowns if they're all on one side of the boat. And so having diversification, and some people may look at a situation like IVOL where it's been down in 24 and say, why would I want to add that as a diversifying asset? But more than likely, I mean, if the risk is to the upside for volatility, with everything that's going on in the economy, in the markets, in the world, in the election, and in geopolitics, I mean, how long can volatility stay at these historically low levels? And normally when they do hit these low levels, do they normally bounce?
It's interesting because we've been in this kind of like bond bull market for a very, very long period of time, with the exception of, of the period of, 22 and more recently when the Fed started raising rates. So I think generally people have been, because the bond market has been in this sort of bull market and, but every single kind of financial crisis, it's always mortgages, right? It's always short volatility that kind of blows up people, right? Whether it's even Silicon Valley Bank, it was the same thing. If you read their, I'm no stock analyst, but if you look at their 10K and even their 10Q, you'll see in the footnotes, they say, oh, our mortgage exposure, because the Fed hiked rates, homeowners didn't prepay as quickly as we modeled, and our duration extended 50%. So you get longer duration right when you don't want to. So it's always these short volatility exposures that cause sort of the surprises in the market, which is why I'm such a big proponent of saying, look, why only be short volatility in your bond portfolio? At least have something that has that exposure to volatility increasing to actually benefit from it. Volatility kind of has like a negative connotation because people think of volatility and losing money. Well, you can own products that are actually long volatility, which isn't always going to make money, but it's something different.
Yeah, no, I think it makes a lot of sense. So, many central banks have been heavy buyers of gold over the last several years instead of buyers of treasuries. What role do you see gold playing in the coming years in the global financial system? And how do you see that role impacting the price of gold?
Yeah, I think look, people I think generally have been looking at gold, and I don't want to upset the gold bugs. I'm not going to say anything bad about gold, except the one thing I will say is it doesn't have carry, right? I think that's the one kind of downside, and it also matters what you have gold in, right? If you own gold in euros, gold in dollars, it's not, there are a lot of different ways that you can own gold, but owning gold versus a carry in a currency that has a very high interest rate is kind of harder, right? Because you're not getting paid that interest rate and you're still, so I think people should have diversification. We actually wrote, it's institutional only, so it's not for retail, but for people who are, financial advisors or financial professionals, I'd be happy to send the paper that we did, for the IVOL ETF about looking at gold in inflationary periods, because I think gold is definitely psychology. Gold is definitely the fiat currency. You could argue maybe crypto has a space in that now too, as a diversifier, but it's not necessarily the best inflation hedge, right? At least historically. Maybe it will be in the future. But I think like anything else, you just don't want to have all your eggs in one golden basket.
Certainly a protection against purchasing power, though. But if you give me the link, if you send me the link to where they would sign up to acquire that paper, I'd be happy to put that up right where you were talking about that.
Okay, cool.
Yeah. So gold is often also considered a barometer for the currency. Gold has broken out of a 4-year consolidation area recently this year. What is gold breaking out of that 4-year consolidation period telling you about the currency, if anything?
I mean, I think it's just a sign that people are getting more worried, right? Which makes sense. Like the fundamentals kind of that are out there do kind of lend itself to be like, aha, that makes sense. I think there are other ways in addition to diversify that might be, different types of, betas out there in the market. I think vol is one of those things. Vol is down about 30% in
Imagine.
2024. I don't think it makes a ton of fundamental sense.
Yeah.
But I look at those and I'm like, look, have a lot of different things in your toolkit, right? There's no reason to be narrow with your diversification, especially in your financial assets and your life savings.
Totally agree. So I have a couple more questions on the commodity front before we get over to your funds. With the previously mentioned electrification and AI movement and the build outs that are well underway, and the global military and weapons expansions we're literally seeing every single day, the rising global consumer class, and all of the other applications that's requiring it, clearly silver is playing a much more important role than it has in quite some time, maybe ever. What is your silver thesis, if any, if you have one?
I mean, we at Quadratic, we have invested in silver over our 11 plus year history. We do not have a product right now that accesses silver, but I do think silver has, I would say, in my experience, like a higher beta than gold to that sensitivity. So it can be a pretty valuable tool, and it also has practical applications as well in kind of the real world, which are nice. So I'm a fan of silver.
And so, Nancy, before we move on from the precious metals, do you have a thesis on the mining complex?
I'm not a single stock analyst, so I think you'll have other guests that are more equipped to answer that in a better, more informed way. I'm a
Yeah,
fixed income volatility expert.
that's fine. I appreciate it. So, with supply chain disruptions persisting for multiple reasons, not the least being all the attacks in the waters of the Middle East, are there any particular sectors or industries that you see as being more vulnerable for the long term, and how are you adjusting accordingly?
I mean, I get a little nervous about liquidity. I think that's one thing. Everything has been fine since Silicon Valley Bank, and there haven't been any liquidity shocks. But I look back at March 2020, and even the Treasury market broke during that period. So I
Mhm.
think a lot more a lot more of the institutional portfolios have moved into illiquid investments, right? Whether it's direct lending or, kind of the whole private credit sphere. And I think less of the institutional portfolios are allocated to things that are liquid, right? That you can't really sell them. So I think that will mean, I think, more volatility shocks in the public markets and more volatility generally in the financial markets that are liquid, because there's not a lot of liquidity in these institutional portfolios.
When those days are coming, when we have those volatility shocks hitting the markets, what's the impact economically? What's the layman going to feel?
Well, I think it's, again, goes back to portfolio diversification, that you don't want to have a portfolio, like, for instance, if you have all equities and all bonds with credit risk, right, you have a lot of exposure to corporates, right? It might be a different part of the capital structure, but if there's a recession or corporates have a problem, you're kind of all in one thing. So I think it just goes back to say, like, look, just try to be as diversified as possible and as thoughtful, and know that not everything is going to go up together, and that's okay. I feel like there's such a huge focus right now on momentum, and you can argue why, and I'm not saying anything negative about momentum, but I think you also have to look at things that are good value. Eyeball is down a lot this year, and I think it's not always going to make money. I'm not making promissory returns or any predictions, but it is something that is different, and I don't think most people have exposure to that inside their portfolio.
I would agree. So, you mentioned, well, you stated the word recession. The consumer has, is really in a bifurcated situation. The bottom 50% is suffering. Their savings are down. Their credit is up. Pre foreclosures are starting to rise. Even on the stock side, there's been um, the consumer stock class like McDonald's and several others are having a hard time. It's being reflective of where that group of consumers is. Do you see that coming to a head and there being do you see the potential of a recession coming in the next 6 months?
I mean, nobody's really worried about that. Like we were hearing, even Jay Powell made a joke in a recent press conference about seeing no stag and no inflation, right? Do you remember that joke? And I think that's probably the biggest risk for investors' portfolios, because that's when typically the 60/40 portfolio loses money together, stocks and bonds become correlated. We haven't really had stagflation in a very, very long time, but I think
Right.
that's definitely a huge risk. We actually have a whole section of our paper, our white paper on IVOL about stagflation. Obviously, IVOL didn't exist during the last period of stagflation. Even the tips market didn't exist until the late 90s. But I think volatility will increase in that environment, especially as, imagine stocks and bonds and models are not as negatively correlated, right? Even if they don't go positively correlated, just reducing that negative correlation could make vol go up quite a bit. I think the yield curve would steepen in that environment, and I think real yields would go lower. So I do think IVOL could be a nice diversifier for people who are worried about, maybe it's not a recession, maybe it's more of just a stagflationary, lower growth, but stickier inflation.
So in that stagflationary environment, do you see higher unemployment? Do you see issues with residential real estate? Maybe not at the same levels of '08, but people who got into high cost mortgages, post the pandemic, and the inflation has taken a bite out of their spending power, and maybe they lose a job or something like that. So do you see any of those types of problems coming?
I don't have a crystal ball about which problems are going to come, but I do know that stagflation is a very serious thing for, portfolios. And I think IVOL may help, it's not guaranteed, but it may help diversify some of that risk, because the Fed has kept rates higher for longer, right? And everybody's sort
Mhm.
of, everybody's still sort of like, when are the rate cuts coming? Like everybody's hand
Right.
is out. And if we had a stagflationary period, like the Fed might cut rates, but that might lead to more and stickier inflation, right? So I think
Okay.
it's just a huge risk. And I think kind of regular people are just sitting there with, kind of the traditional 60/40 portfolio. And that's kind
Yeah.
of the a dangerous place to be.
So I'm going to ask you a
Oh,
question on
yeah.
that 60/40 portfolio in a moment, but I was hoping that, Nancy, you could tell us about your funds, both funds, how they're positioned, what the thesis is for each, and what your go forward expectations are.
Yeah, so both of the funds are treasury funds for the most part. About 80% of each fund is invested in US treasuries. And then we use fully funded interest rate options to add kind of this differentiated access to the rates market. Most people have exposure in the financial portfolio to, stocks, bonds, maybe some own commodities or other asset classes, but a lot of people do not have access to rates, and it's a
Mhm.
huge market. Um, so with IVOL, we benefit from falling real yields because we have exposure to Treasury inflation protected securities, sometimes called TIPS. So we want higher tip prices, meaning lower real yields. We
Mhm.
also want rising volatility is good for the fund. It's interest rate vol, it's not equity vol. And then we want a less inverted yield curve, or a normal yield curve, meaning upward sloping. Right now, the choose 10s dollar SOFR market, which is just an interest rate market. That spread is -70 in the spot terms. So that going less negative is positive for the strategy.
So we've been talking about a sustained inflationary environment, and that kind of environment looks very different than the previous several decades. where lower interest rates, declining costs on everything was really the prevailing theme. The 60-40 portfolio, as you've really been talking about, was the ideal environment, the ideal portfolio for that environment, but it just doesn't seem like that environment is the same environment any longer. So with this sea change taking place, if the 60-40 portfolio is no longer the best outcome, how would you structure the model portfolio today?
I mean, I think you have to be careful with all these buzzwords, right? Like there's so much jargon in our industry, and even things like, short duration, right? Like within short duration strategies, there are short duration strategies that are all governments, and then there's some that are mostly structured products, which, you just have to be careful about credit risk and what you can't go by name only. I think it's really important to look
Yeah.
into what these underlying strategies have. Right now, a lot of people have been worried about duration risk, but not many people are worried about credit risk right now. The 2-year investment grade CDX index, for instance, is about 20 basis points. It can't go to zero, so you want that lower. You want credit spreads tighter when you own a bond with credit, and credit is really very tight. You have a lot more yield, and that's because of interest rates, but you're not getting paid a ton to take credit risk. And then with the inverted yield curve, you're literally like, it's almost like paying a tax if you own a 10-year treasury getting 4.25 today versus the overnight policy rate. You can buy a 1-month T-bill and get paid 100 plus basis points more to own a short-term bond instrument. So it's a really wonky market
no
out
risk.
there. So, yeah, it's like it's kind of wrong way risk right now in the bond markets.
Yeah, upside down world. So what are the top trends that you're watching or looking out for over the next 1 to 2 years?
So I'm very happy to create these ETFs. We actually just rang the bell on the New York Stock Exchange.
Congratulations.
Thank you, for our 5-year anniversary of listing Eyeball. So it's been over 5 years that the fund has been out there. It's different, right? A lot of products out there and asset management strategies kind of do, I don't want to say the same thing, but they have similar benchmarks and are similar things that people are used to seeing. This is something different. It's not appropriate for everybody, but I think, I'm very proud of, giving investors choices and creating a listed product that really anyone in the world can use it because it's traded on the stock exchange.
Well, before we wrap up here, this has been a fascinating conversation, and I ask you the final question. I just want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Nancy as much as I have. Please let her know. Hit the like and subscribe button and leave a comment below the video. Nancy, in wrapping up our discussion, my final question is about portfolio positioning. Based on everything that we've discussed and with your experience, your expertise, and your worldview as the backdrop, how are you positioning for the months ahead? What assets do you like, and what assets do you absolutely want to stay away from?
Yeah, so I'm a portfolio manager for the Eyeball ETF and the BNDD ETF. So I'm not really an asset allocator or a financial advisor. So I think it's I think I would say just be diversified is kind of my key takeaway. You want to have lots of different things in your asset allocation, and I think when the market's giving you an opportunity, especially in the volatility markets, to have something that could be negatively correlated to your other holdings. I think that's interesting, and something people should look at and see if it's appropriate for them or their clients.
That's a great point. Nancy, thank you for coming on to Metals and Miners and for being so generous with your time, your analysis, and your ideas. It's been awesome to spend this time with you. Would you please share with the viewers any final thoughts that you want to leave them with, where they could learn more about your work and how they can connect with you?
Oh, awesome. Thanks, Gary.
Yeah.
So we are, we have ETFs. They're 1940 Act, publicly traded funds. So we're pretty transparent about what they do and what they are. So probably the easiest way to contact us or learn more about the strategies would be going to the fund websites. So for IVOL, it's just IVOL. It's not it's like like inflation or interest rate volatility, IVOL, ETF.com. And then for our deflation fund, it's BNDD, like bond deflation, ETF.com. And those websites have also a contact us page where people are welcome to reach out if they want any questions answered or they want to call to learn more.
Well, I will go ahead and put all of your information up on the screen. There'll be links in the description area of the video. Everybody, you really need to at least check Nancy out, check out her, both her funds. It's important. And I think the takeaway is to have that negative correlation in your portfolio. So, if you're concerned about an increase in volatility, if you're concerned about having too many assets on one side of the boat, then having the negative correlation is going to be very important. So thank you, Nancy, for being here. I look forward to having you back on. And everybody else, thank you for watching.
Thank you, Gary.